Mortgage rates set to explode. Will the housing market crash as a result? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's go over interest rates, inflation expectations, how this affects home affordability, therefore prices. We know right now the government is giving everybody stimmy checks in the mail. This is increasing income. And I know you hear that often, but you've got to understand how dramatic the numbers are. Just in the first part of 2021, incomes increased by 10%, something you wouldn't even see if the economy was booming. And we know that's definitely not the case. But let's also remember there is a moratorium on rents. We have mortgage forbearance. So people's incomes are going up, their expenses are going down. But at the same time, the government has instituted lockdowns, therefore forcing many businesses to go bust. We've had hundreds of thousands of small and mid-sized businesses shut their doors, and they're never coming back. So incomes go up, expenses go down. The amount of stuff, goods and services in the real economy also goes down. This leads to one thing, consumer prices going up. And the market is telling us in a variety of ways that it expects prices to move higher. Couple charts here. Actually, before we get to this one, editor, throw up a chart of copper. Let's take a look at what it has done over the past year. It's gone straight up to a point now where it's almost at an all-time high. This is one way of the market telling us it expects consumer price inflation in the future. Let's look at this chart. 10-year Treasury. We start December 20th, go all the way to March 2021. On the left, we go from 75 basis points up to a whopping 1.5%. And I know these numbers are small, but the amount, the percentage increase has been dramatic. We started December 20 under 1%. It goes down slightly. It really went up in January of 2021, plateaued a bit, but then it's gone straight up over 1.5%. Now it's dipped down just a little, but you can see the trend line going straight up. Well, if the 10-year Treasury rate is going up, what does that do to mortgage rates? Let's look at another chart. Same time frame. On the left, we go from 2.64% up to 2.82%. Again, it's not a huge move in terms of the actual amount that it's gone up, but when you look at it in terms of a percentage of increase, it is definitely substantial. It starts at 2.7% in December, then pretty much tracks along this same line. We get to a point right now where we're higher, much higher than we were in December of 2020. But the main thing I want you to notice is the trend line going up here because of inflation expectations, and the trend line going up here as well on the 30-year mortgage. So if mortgage rates are going up, as most of you know, that's going to put downward pressure on home prices. So the next question becomes, how much downward pressure? And what if interest rates continue on their current trajectory, going straight up to a point where they actually normalize? Let's say go back to the rates we saw in the 1990s. Let's start by using an example, kind of the average home, I guess, $300,000. We'll put 10% down. At a 3% interest rate, assuming we have a 30-year fixed rate mortgage, the payment would be $1,534. Editor, let's go ahead and throw up the mortgage calculator so the viewer can follow along with these numbers. But if interest rates went up to where they were just in the 1990s, so nothing extreme like when Paul Volcker came in and jacked rates up to 18%, and who knows what mortgage rates were back in the early 1980s, but nothing that extreme, just going back to kind of an average. That would take someone's payment for the exact same house, an apples to apples comparison, up to $2,377. So most people that can afford $1,500 probably could not afford $2,300. So let's think this through. If someone can only afford that $1,500 payment and rates go up to 8%, how much home can they afford? Well, back here at 3%, they could afford a $300,000 home. Here at 8%, they can only afford a $190,000 home. This means purchasing power across the board would go down by 36%. If demand or purchasing power goes down by 36%, what does that do to home prices? They go straight down. So the bottom line is, if the government continues to deficit spend like we have never seen before, an M2 money supply goes parabolic. That's the amount of currency units in the real economy chasing goods and services. We will see expectations for inflation continue to rise. If that happens, the 10-year goes up, mortgage rates go up, and at a certain point, that will affect affordability enough to start bringing down prices, potentially even create a housing market crash. Step number 2, Fed intervention. I know after step number 1, a lot of you watching this video, or maybe your friend and family member, Fred, that guy, and everyone's got one in their family that just hates Austrian economics, and is a big fan of big government and a big fan of the Fed. They're probably watching and saying, George, the Fed is never going to let mortgage rates go up. They'll just come in and buy mortgage-backed securities, or they'll peg the yield curve. They'll do something so we never, ever have to worry about the housing market crashing. Well, as many of you can guess, this may create some unintended consequences that are even worse, believe it or not, than the housing market crashing. So let's go through the plumbing of how this works, and then in step number 3, we'll connect all the dots so you can determine the probabilities of the housing market crashing. Let's go ahead and dive right in. First, the government spends money. We talked about the deficit spending in step number 1. You've heard about it in the news constantly. In 2020 alone, they had almost a $5 trillion deficit. And I believe that 2021, it's only going to increase. So your drunk, insolvent Uncle Sam spends money into the real economy. He's sending out those STEMI checks to Moody, the millennial, and heroin guy. We talked about both of them in another similar video Thursday night. We'll put a link in the description below. But the government needs to issue treasuries so your drunk, insolvent Uncle Sam can spend the funny money into the economy. So they sell them at auction. Those go into the overall treasury market. Sometimes the banks will buy them, individuals. There are different entities out there buying those treasuries. So if the Fed comes in and needs to decrease interest rates, let's say on the 10-year or the 30-year, they need to increase demand because the price and the interest rate has an inverse correlation. So if the demand goes up because the Fed is in there buying, prices of those treasuries will go up. Therefore, the interest rates will go down. So the Fed comes into the treasury market to buy those treasuries to peg the yield curve or to prevent mortgage rates from going up so the housing market doesn't crash due to inflation expectations and interest rates rising. But what we need to think through is how the Fed actually buys those treasuries. What do they use to pay for them? This is what some people refer to as money printing, but it's not really money printing because it doesn't affect those currency units in the real economy. They just create bank reserves out of nowhere and they credit the account of the individual or entity they're buying the assets from, whether they're treasuries, mortgage-backed securities, you name it. So the Fed's balance sheet has the liabilities and assets. Let's say right now they have mortgage-backed securities and the bank reserves they created out of nowhere to buy those assets, but they need to go into the treasury market. So they buy those treasuries that the government just issued, let's say. Those treasuries are now an asset of the Fed, but as you can guess, they had to create more bank reserves. Why is this important? Because those bank reserves are actually assets of the commercial banking system, and they don't really hold a lot of value. So those banks much prefer to have T-bills, what we call the short end of the yield curve. So 1 month or 3 month debt issued by the government. What ends up happening is the Fed creates more and more bank reserves. We have an imbalance between the amount of bank reserves and the actual T-bills available for the banks to purchase. So if the demand for T-bills goes up due to an increase in bank reserves, the price goes up as well. If the price goes up, the interest rate goes down. And again, I talked about this in Thursday night's video. So if you're not really following the process, make sure you check that out. We'll put a link in the description below. But what this does to the T-bills is potentially takes the interest rate negative. Right now, the yield curve looks something like this. And it's kind of smashed in there or bunched in there next to heroin guy. I need more room on my whiteboard. But we start with 1 month, 3 month, 1 year, 10 year, 30 year here. On the left, it goes from 0% up to 2%. Right now, the front end or the short end of the yield curve, very low, almost at 0. Then 1 year, it starts going up just a little bit. And then 10 year, 30 year, it really starts to head north. So we call this a steepening yield curve. And this is what we talked about in step number 1 that could potentially affect mortgage rates. But what happens if the Fed creates too many bank reserves is the short end of the yield curve actually could go negative because of the demand-supply imbalance we were talking about earlier. So we could see this environment where the short end of the curve goes negative, but the long end of the curve is still going straight up. To explore this process even further and to understand how the Fed may even be forced to raise interest rates. That's right, I said raise interest rates at the front end while they're trying to lower interest rates at the long end. Let's cut to a clip from Bloomberg.
Theoretically, rates going negative, but in practice, the Fed not wanting them to go there. Can you just walk me through that a little bit more?
Sure. That's exactly right. So if you think about the front end of the curve, you're going to have more cash chasing not all that much additional Treasury debt. So when you have more cash, less collateral, that puts downward pressure on rates. That could very well push Treasury bill rates into negative territory. We're already seeing very front-end rates just a couple of basis points above 0. When this cash hits, though, it very realistically could push those Treasury rates into negative into negative yields. Now, the Fed doesn't really like that because they don't want rates to trade negative. The U.S. Treasury doesn't think that it's good because they can't actually issue bills at negative offerings. So what the Fed is likely to do is to raise interest rates slightly and try and pull those rates out of negative territory and keep them still in somewhat positive territory. They're going to do that through a tool that they have called the interest rate on excess reserves, or IOER. And they've told us that this is a technical adjustment that they will be making, but we think it's quite likely that the Fed needs to do this at or before the March FOMC meeting. So you could be looking at a technical rate hike in the not too distant future.
Okay, Mark, this is fascinating and super important, and it sounds really technical, but it highlights the incredible distortions that are created so close to the lower bound and how challenging it is to maintain equilibrium. Is there anywhere else that this cash can go within the fixed income world, or is it just going to sort of stay here based on these technical needs of both bank reserves as well as what the Treasury is doing?
It's a great question. So it's going to be most concentrated at the front end of the curve, we believe. However, it's likely to propagate somewhat out the curve. Now, what this means, generally speaking, is that all else equal, U.S. interest rates should be modestly lower than they otherwise would be as this cash enters. And we're seeing that. Again, it's really not in an outright level place where you can see it, but if you look at spreads, swap spreads, or U.S. Treasury yields versus Fed funds expectations, or OIS, you see Treasuries richening, not just at the 2-year point, but also out to the 5-year point.
Right.
So it will be a technical driver that actually supports curve steepening, because it's going to put some downward pressure on the front end of the curve.
Fold in the behavioral construct, Mark Cabana, of propagating out the yield curve. Folks, this is some fancy mathematics of the makeup of the yield curve. But Mark, give us the behavioral requirement that big money, big institutions have to propagate out the yield curve towards a 5-year duration.
Yeah, well, you know what? The Fed has talked about this in the past through something called the portfolio balance effect. The theory essentially goes that when the Fed buys a lot of assets or when there's a lot of cash in the banking system, you push investors a bit further out in their preferred habitat.
Do you observe that right now?
Absolutely.
Just in case you guys weren't following that completely, let me go ahead and translate it into English for you. What this gentleman, Mark Cabana, with Bank of America was saying is because the Fed doesn't want negative interest rates at the short end of the yield curve, they may have to come in and increase the Fed funds rate by increasing what they call IOER, or interest on excess reserves. That's just a fancy way of saying they need to increase this interest rate, the Fed funds rate, to bring those rates from negative territory into positive, at least above zero. But he also went on to say that this is going to create some serious distortions by forcing entities and financial institutions to go further and further out the risk curve to find yield. Normally, they would buy a 1-month or a 3-month T-bill, but now they might have to buy something 1-year or 5-year to maturity. Why is this important? Because if you're holding on to debt from the government for 5 years, you've got way more inflation risk than you do if you're holding on to something for a month or 3 months. The bottom line is the Fed may have painted themselves into a corner where they're going to have to make a very difficult decision. Number one, do they allow interest rates to continue to go up and potentially crash the housing market along with the entire U.S. economy? Or their second option, do they come in and try to manhandle interest rates by creating more bank reserves, which could have unimaginable unintended consequences? Step number 3, let's go over some of the unimaginable unintended consequences that may prevent the Fed from stepping in and micromanaging mortgage rates if they are exploding higher. And you may be saying to yourself, George, it doesn't even matter because there's nothing that would be as bad as the housing market crashing. The Fed is never going to let that happen. I wouldn't be so sure. What I'm going to reveal next is going to illustrate just how dire this situation is. Editor, let's go right to the internet. Let's start by going back to September 2019 and the repo market. Remember that? Remember when the repo rate spiked up to almost 10%? It was down near 2%. And the Fed they did lose control of the overnight rate, the Fed funds rate, momentarily. So we pull up a chart, we're cruising right along around 2%, and then all hell breaks loose. Rates jump straight up to 10%. The Fed has to intervene because they completely lose control of the Fed funds rate. So why is this important? Because if the Fed is losing control of the Fed funds rate, that tells us that they're going to lose control over every single interest rate along the entire yield curve and in the entire U.S. economy. So if repo rates explode higher, mortgage rates will also explode higher. Now let's move on to a diagram mapping U.S. dollar funding flows. And this is kind of boring, esoteric stuff, but if you think about it, it makes sense. This is just showing us how the money flows when repo transactions are done. So the main investors, retail, not so much with repo, but the prime money market funds. That's what I want to point out. They're executing these transactions going through the primary dealer banks, and the entities that are being funded, financial institutions, hedge funds, etc. So the next question becomes, what percentage of these repo transactions are the money market funds responsible for? And why should I care, George? What does this have to do with the housing market and mortgage rates? Okay, let's move on to the next chart. This shows us how crucial those money market funds are in the repo market. Look at March 31st, 2020, going back to the cerveza sickness, and we look at the total amount of repo transactions done with treasuries. Money market funds provided 66% of the liquidity. Let me say that in a slightly different way to make sure we're all on the same page. In a repo transaction, there's a financial institution that needs cash and they need it quick. Maybe it's for one night, maybe it's for 2 weeks, it's for a specific time. So the money market funds come in and give them the cash they need. If there are no money market funds there, 66% of the liquidity or the cash available is gone. If you still have the same demand, which we most likely would, what would happen to the interest rate or the price of the available cash? It would go through the roof. And again, if repo rates go through the roof, so do mortgage rates. So why would people or entities take all of their money out of these money market funds? Because of negative interest rates. There's no way anyone would pay to have their money in a fund when they could just keep it in a checking account, and maybe they wouldn't make any interest, but at least they wouldn't lose any money. So the takeaway is, if the Fed comes in and tries to micromanage mortgage rates, if they're going up due to inflation expectations, they're going to have to print more bank reserves. This could take T-bills negative. If the T-bills go negative, this would affect the money market funds, which could lead to another repo spike. If the repo rates spike, ironically, so do all of the interest rates in the real economy, including mortgages. So as usual, the Fed could paint themselves into a corner by trying to solve the problem of high mortgage rates. They exacerbate the problem and create even higher mortgage rates than they had to begin with. Now you may be saying to yourself, George, okay, I get it. There's gotta be something you're missing. There's no way it's just inevitable that mortgage rates go exploding up while housing prices come crashing down. There's gotta be some sort of financial engineering the Fed can pull out of the bag. Well, to a certain extent, you're right. Let's go through some of those. The first thing the government could do is they could roll over their long-term debt into short-term debt. The short-term debt are the T-bills that the market needs. That's where there's extremely high demand. So if you produce more supply of the T-bills, the price goes down, interest rate goes up. So if the government has some 10-year treasuries or 30-year treasuries that are maturing, let's say in the next few months, well, instead of issuing just more 10-year or 30-year treasuries to roll over the debt, because obviously they can't pay it off, they could just issue more T-bills. But as you can imagine, there's a problem with this. Right now, we have about 27 trillion in debt. Maybe up to 28 trillion now, who knows, as fast as the government is deficit spending. But this 27 trillion isn't entirely made up of bonds and notes. In other words, 10-year and 30-year treasuries. In fact, it's just a small percentage. So let's assume that they rolled over all of their long-term debt. So the only thing they had outstanding were these treasury bills. Great. Now all of a sudden there's a lot more supply, like we said. So the price goes down, interest rates goes up, no more negative short end of the yield curve. But let's think this through. What was the problem that created the GFC back in 2008? It's because the average Joe bought all these houses, let's say for $500,000, with an adjustable rate mortgage. So their mortgage rate to begin with, or the amount of interest they were paying on their debt, was, let's say, 1%. But then when it adjusted up to 7%, all of a sudden the average Joe couldn't make the mortgage payment and the whole thing blew up. You know the rest of the story. So if we move all 27 trillion of the government's debt to the short end, it means they'll have to roll it over every single year, because all of the debt they have will mature within the year. So what this does is it turns your drunk, insolvent Uncle Sam into the largest subprime borrower with an adjustable rate mortgage in human history. In other words, there's no way the Fed could ever increase interest rates, no matter how bad inflation got, because if they did, they'd completely crush the government. So let's assume for a moment they're smart enough to understand how precarious a position that puts them in. And I know that's a big leap of faith. So let's take that off the table for a moment and explore some other alternatives. Well, the Fed could sell all the T-bills they have on their balance sheet, because again, this would increase the supply of those T-bills and helping equal out that imbalance. Editor, let's go ahead and cut to the Fed's actual balance sheet, and we can see that the Fed currently only has about $300 billion worth of T-bills. So my point is they don't have that many to sell, at least not enough to make a dent in the problem. So we take that off the table. And the third alternative, as crazy as this sounds, is the government would have to spend more and more money. And to generate those funds, they issue more T-bills, more of the collateral the market needs. But there's another problem. What would happen if the government is spending all of those new currency units into the economy, chasing goods and services? We most likely see consumer price inflation, at least expectations, go up. If inflation expectations go up, what happens to 10-year and 30-year treasuries? They go up. If they go up, so do mortgage rates, which takes us straight over to a doom vortex or a doom loop. It starts with too many bank reserves in the system from all this quantitative easing the Fed has done over the last few years. It could result in negative interest rates on these T-bills that could lead to a huge blow up in the repo market, because everyone is taking their money out of the money market funds that provide the money or the liquidity to the entities in the repo market. We know the Fed will avoid that at all costs, so they have to think of a different solution. But the first one would make the government, your drunk, insolvent Uncle Sam, the largest subprime borrower with an adjustable rate mortgage in human history. This puts us in a very bad situation that we don't want to be in. So the only other realistic alternative is for the government to just spend more and more money, deficit spend. This could increase inflation expectations, which makes mortgage rates spike, housing prices go down, which could also bring the whole house of cards crashing down. But in order to avoid that, the only thing the Fed could do is create more bank reserves. So to answer the original question, will mortgage rates explode and will this lead to a housing market crash? My answer actually is no. Probably surprised a lot of you watching right now. Why do I say this? Because I think, going back to the repo market, the Fed would intervene and most likely take over the entire system. This would lead to even more and potentially even worse unimaginable unintended consequences and knock-on effects. But we'll have to save that for a completely separate video. So now that you understand how all of this plumbing works, let me know in the comments below what you think is going to happen to mortgage rates and housing prices in the future. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.